In the world of wealth creation, there's one magic word that often goes hand in hand with success: assets. But what exactly is an asset, and why is it so crucial in your journey to financial prosperity? An asset is anything you own that has the power to grow and generate income for you, often without you having to actively work for it. In simple terms, it's anything that puts money in your pocket continuously. The remarkable thing about assets is their ability to multiply your money through a process called compounding. This means that your money earns money, which, in turn, earns more money. And this compounding effect is the key to wealth accumulation. What's even more intriguing is that many assets can generate passive continuous income, which means you can make money without actively working for it. It's like planting a money tree that keeps bearing fruit even when you're not tending to it. In this video, we're going to learn the 12 all-time best assets that not only harness the power of compound but also generate passive income continuously and have the potential to make you rich over time. 1. Your health. Health, without a doubt, is one of your most valuable assets and the most precious asset you have, as it plays a fundamental role in your ability to accumulate and enjoy wealth. Good health contributes to your ability to earn income, make sound financial decisions, and enjoy a fulfilling life. Investing in your health is not just about medical expenses, but also about maintaining a healthy lifestyle, which can have a profound impact on your long-term financial security. For this reason, investing in your health is a vital aspect of any comprehensive wealth-building strategy. Maintaining good health involves various elements, including regular exercise, a balanced diet, adequate rest, stress management, and preventative health care such as regular checkups. Screenings and healthy habits can detect and prevent potential health issues before they become more costly to treat. These practices not only enhance your physical well-being, but also contribute to your mental and emotional health. When you're in good health, you have the energy and mental clarity to pursue career opportunities, make sound financial decisions, and enjoy your wealth more fully. Furthermore, a healthy lifestyle can lead to reduced healthcare costs and, consequently, more savings and investments for building wealth. Investing in your health is an investment in your overall quality of life and long-term financial security. 2. Individual retirement accounts. Individual retirement accounts, IRAs, are essential assets for continuous income and wealth accumulation in retirement. They provide a wide range of tax advantages, including tax-deferred or tax-free growth on investments, and they offer significant control over your investment choices, ensuring that you can tailor your portfolio to match your financial goals and risk tolerance. IRAs also grant flexibility when it comes to early withdrawals for specific needs, such as higher education or the purchase of a first home, without incurring penalties. Most importantly, IRAs can provide a continuous stream of income in retirement through systematic withdrawals or annuities, ensuring financial security during your golden years. On the other hand, while employer-sponsored retirement accounts like 401k are indeed excellent options for retirement, they may not be considered continuous wealth-building assets due to certain limitations. These accounts often restrict your investment choices to a predefined set of options selected by your employer, limiting your control over your investment strategy. Furthermore, accessing funds in a 401k account in the U.S. can be subject to penalties if done before the age of 59 and a half. Additionally, when you leave your job, you may be required to move your employer-sponsored retirement account like a 401k into another employer plan or an IRA, which can limit your investment choices and control. In contrast, IRAs remain under your control, offering greater flexibility in managing your assets according to your specific financial goals and providing a seamless and continuous income stream throughout your retirement journey. 3. Mutual funds. Mutual funds are a great starting point for many investors. especially if you're just beginning your investment journey. These funds pool money from a variety of investors and are managed by professional portfolio managers. The primary objective of a mutual fund is to achieve a specific financial goal, such as long-term capital growth, income generation, or a balanced approach. One of the most significant advantages of mutual funds is diversification. By investing in a mutual fund, you gain exposure to a wide range of stocks, bonds, or other securities, spreading risk across multiple assets. This diversification helps mitigate the impact of poor performance by individual holdings, making it a less risky option for investors. There are various types of mutual funds, each with its own set of characteristics and objectives. For instance, equity mutual funds primarily invest in stocks, bond funds focus on fixed income securities, and hybrid funds combine both stocks and bonds. This diversity allows investors to tailor their portfolios to match their risk tolerance and financial goals. Investing in mutual funds is relatively straightforward. You can choose funds based on your risk profile and investment horizon, and you can typically start with a relatively small initial investment. Furthermore, many mutual funds offer the option of automatic investments, making it easy to set up a systematic investment plan. However, it's crucial to be aware of management fees associated with mutual funds. These fees, known as expense ratios, cover the operating costs of the fund and are expressed as a percentage of your investment. Lower expense ratios are generally preferable because they allow you to keep a more significant portion of your returns. 4. Index funds. Index funds have gained immense popularity in recent years due to their simplicity and the compelling benefits they offer to investors. These funds are passive investment vehicles designed to replicate the performance of a specific market index, such as the S&P 500 and NASDAQ. They have several key advantages that make them an attractive choice for both novice and experienced investors. One of the primary benefits of index funds is their low cost. Since they aim to mimic the performance of an index rather than actively selecting individual securities, the fees associated with index funds are generally much lower than those of actively managed mutual funds. Lower fees mean more of your investment returns remain in your pocket over the long term, which can significantly boost your overall wealth accumulation. Diversification is another major advantage of index funds. By investing in an index fund, you automatically gain exposure to a wide range of other investment vehicles, depending on the index being tracked. This diversification helps spread risk across various asset classes and reduces the impact of poor performance by any single company or sector. It's a simple yet effective way to mitigate risk in your investment portfolio. The consistent, long-term returns of index funds make them particularly suitable for passive investors with a buy-and-hold strategy. Rather than attempting to time the market or pick individual stocks, you can invest in an index fund and allow your money to grow over time. The historical performance of major indices has demonstrated steady growth and outperformance compared to many other investment options, which is a compelling reason for their popularity. Investing in index funds is also incredibly convenient. They are readily available through brokerage accounts, and you can buy or sell shares at any point during market hours. This liquidity allows you to easily adjust your investment portfolio based on your financial goals and risk tolerance. Furthermore, automatic investment plans can be set up, enabling you to make regular contributions and benefit from dollar-cost averaging. It's important to remember that index funds don't provide the same potential for outsized gains that active stock picking might offer. They are designed to capture the overall market performance, which means you won't see significant deviations from the index returns. Additionally, while they are low risk compared to many other investment options, they are not entirely risk-free, and market downturns can still impact their performance. 5. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are similar to mutual funds in that they offer diversification and professional management. However, there are some key differences between the two. One of the most notable distinctions is that ETFs trade on stock exchanges. This means you can buy and sell ETF shares throughout the trading day at market prices, which provides liquidity and flexibility. Mutual funds, on the other hand, are typically priced and traded only at the end of the trading day. ETFs also tend to have lower expense ratios compared to mutual funds, which is a significant advantage for investors looking to minimize costs. The structure of ETFs makes them more tax efficient as well. When you sell an ETF, it's generally considered a capital gain or loss, whereas mutual fund redemptions can trigger capital gains distributions, which may have tax consequences. Another unique aspect of ETFs is their ability to track various indices. For example, you can invest in an ETF that aims to replicate the performance of the S&P 500 or any other benchmark index. This passive approach to investing can be cost-effective and straightforward for individuals who want exposure to specific market segments without the hassle of stock picking. However, it's essential to be aware that some ETFs are more specialized and can be riskier. Leveraged and inverse ETFs, for example, are designed for short-term trading and may not be suitable for long-term investors due to their higher risk and complexity. 6. Stock market. Investing in individual stocks is often considered one of the most direct ways to participate in the growth of the economy and generate wealth. When you purchase shares of a company's stock, you essentially become a partial owner of that company. Your returns are based on the company's profitability and its stock price performance. One of the primary attractions of the stock market is the potential for high returns. Historically, over the long term, the stock market has outperformed most other asset classes. However, it's essential to note that the stock market can be highly volatile. Prices can fluctuate significantly in the short term, and this volatility can be a source of both opportunity and risk. To navigate the stock market successfully, you'll need to conduct thorough research on the companies you're interested in. Consider factors such as a company's financial health, competitive position, growth prospects, and the quality of its management. You can also use various financial ratios like the price-to-earnings (PE) ratio to assess a company's valuation and determine whether its stock is undervalued or overvalued. Another essential concept in stock market investing is diversification. By spreading your investments across different stocks, sectors, and industries, you can reduce the risk associated with individual company performance. Diversification can be achieved through mutual funds, exchange-traded funds, or by building your own portfolio of individual stocks. Long-term investing is a key strategy in stock market wealth building. By holding on to your investments for many years, you can ride out market volatility and benefit from the compounding effect. Historically, stocks have provided average annual returns that outpace inflation and can help your wealth grow significantly over time. While there's no surefire way to predict the stock market's short-term movements, various investment strategies such as value investing, growth investing, or dividend investing can be used to guide your stock selection process. Keep in mind that investing in stocks requires a degree of risk tolerance and a willingness to endure market fluctuations. It's wise to set clear financial goals, create a diversified portfolio, and stay informed about the companies in which you're invested. 7. Dividend stocks. Dividend stocks are a subset of the broader stock market, but they have distinct characteristics that make them attractive to a particular type of investor. These stocks are issued by companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. Dividends are typically paid on a per-share basis, and they are often considered a source of passive income. One of the primary advantages of dividend stocks is the consistent income they provide. For investors seeking regular payouts, dividend stocks can be an excellent choice. These dividends can supplement your income, support your lifestyle, or be reinvested to purchase more shares, which can accelerate your wealth accumulation over time. Dividend stocks are particularly appealing for long-term investors who prioritize stability and reliability. Companies that consistently pay dividends are often more mature and financially stable, which can reduce the risk associated with volatile, high-growth stocks. They can be seen as a hedge against market downturns since the income generated can help offset potential losses in stock value. There are various categories of dividend stocks, including blue-chip stocks, which are shares of large, well-established companies with a history of stability and reliability, and are often considered the backbone of a dividend stock portfolio. Dividend aristocrats, which are companies that have increased their dividend payouts for a set number of consecutive years that target companies with a strong commitment to shareholder returns, and high-yield dividend stocks which offer a higher dividend yield, which can be attractive for income-focused investors. It's important to note that dividend stocks may not offer the same level of capital appreciation as single stocks, but they make up for it by providing a consistent income stream. Additionally, their relative stability can be an asset during economic downturns when stock prices are more volatile. Also, it's important to know that not all dividend stocks are created equal, and it's crucial to conduct thorough research before investing. Evaluate a company's financial health, dividend history, and growth potential. Look at metrics like the dividend payout ratio, which shows the percentage of earnings a company pays out as dividends. A lower payout ratio can indicate sustainability and room for future dividend increases. 8. Real estate. Real estate investment is a tried and tested method of accumulating wealth that has produced many success stories over the years. It involves purchasing and owning properties for various purposes, such as generating rental income, capital appreciation, or a combination of both. One of the primary benefits of real estate investment is the potential for steady cash flow through rental income. If you own rental properties, tenants pay you rent on a regular basis, which can provide a reliable income stream. Additionally, as you pay down your mortgage and the property appreciates in value, your equity in the property increases, effectively growing your wealth. Real estate is also known for its potential for capital appreciation. Properties tend to increase in value over time, although there can be market fluctuations. Historically, real estate has appreciated in value in the long run, which can provide a substantial return on investment when you decide to sell the property. Real estate markets can vary widely by location, so it's essential to research and select properties in areas with potential for growth. Another advantage of real estate is leverage. Real estate investments often involve borrowing money to purchase properties through mortgages. This allows you to control a more significant asset with a relatively small initial investment. Leverage can amplify your returns when the property appreciates, but it also increases the risk as you have to cover the mortgage payments. Real estate investment can take various forms, including residential properties, single-family homes, apartments, commercial properties, office buildings, retail spaces, and real estate investment trusts, or REITs. REITs are an excellent option for those who want exposure to the real estate market without directly owning and managing properties. They provide liquidity and diversification by pooling investments in a portfolio of real estate assets. However, real estate investment requires active management and carries risks. You have to handle property maintenance, deal with tenants, and navigate property market cycles. Market conditions can affect both rental income and property values, so it's important to have a long-term perspective when investing in real estate. Additionally, real estate investments may require significant upfront capital, including the down payment, closing costs, and potential renovation expenses. 9. Government securities. Government securities, often considered one of the safest investments available, are debt instruments issued by governments to raise funds for various purposes, such as financing public projects and managing their budgets. These securities are often treasured by investors seeking safety and stability, making them an important component of many portfolios. One of the key features of government securities is their reliability. They are typically backed by the full faith and credit of the government, which means that the government is committed to repaying the principal amount and interest as promised. This assurance of payment makes government securities an attractive option for those who prioritize the preservation of capital over high returns. Government securities come in various forms, such as treasury bills, treasury notes, and treasury bonds in the United States. These securities have different maturities, with treasury bills having the shortest maturities, ranging from a few months to a year, treasury notes having medium-term maturities, 2 to 10 years, and treasury bonds having long-term maturities, over 10 years. Investors can choose the maturity that aligns with their investment horizon. Furthermore, government securities provide a predictable and regular income stream through interest payments. These payments are generally considered safe and dependable. The interest earned on government securities is often exempt from state and local taxes, and in some cases, federal taxes, which can make them more tax efficient for investors. Government securities are also highly liquid, meaning you can buy and sell them in the secondary market with ease. This liquidity provides flexibility, allowing investors to access their funds when needed without waiting for the security to mature. While government securities are often perceived as low-risk investments, they may not offer the same level of returns as riskier assets like stocks or corporate bonds. The yields on government securities are generally lower, reflecting their safety. For investors with a long-term focus, this might lead to returns that only slightly outpace inflation. 10. Commodities. Commodities are raw materials or primary agricultural products that are traded in standardized forms on various exchanges. They can be categorized into several broad groups, including energy commodities like oil and natural gas, agricultural commodities such as wheat and corn, and precious metals like gold and silver, among others. Investing in commodities can be a valuable part of a diversified investment strategy. One of the key reasons to consider commodities as an investment is their potential to act as a hedge against inflation. The prices of many commodities tend to rise during periods of inflation or economic uncertainty. For example, the demand for gold often increases when investors seek a safe haven during turbulent economic times. Commodities can also add diversification to your investment portfolio. They typically have a low correlation with traditional assets like stocks and bonds, which means their price movements may not always align with the performance of these other asset classes. This lack of correlation can help reduce the overall risk of your portfolio and provide a potential source of returns when other assets are underperforming. Investing in commodities can be done through various methods, such as purchasing physical goods like gold coins or barrels of oil, commodity futures contracts, or ETFs that track the performance of specific commodity indices. ETFs from commodities can be particularly convenient for investors, as they offer liquidity, transparency, and diversification within the asset class. However, it's crucial to recognize that investing in commodities comes with its own set of risks. For instance, commodities can be volatile and subject to supply and demand fluctuations, geopolitical factors, and currency movements. Additionally, Owning physical commodities like gold may involve storage costs and security concerns. The specific approach to investing in commodities should align with your investment goals and risk tolerance. Some investors use commodities as a hedge or a way to add diversification to their portfolios, while others actively trade in commodity markets to seek short-term price movements. It's also essential to consider the role of commodities within your overall investment strategy. Depending on your objectives, commodities might be used as a portfolio stabilizer, an inflation hedge, or a source of speculative returns. The key is to carefully evaluate the risks and benefits of commodities and determine how they fit into your broader investment plan. 11. Protective assets. Protective assets refer to various forms of intellectual property rights that individuals and businesses can use to safeguard their creative works and innovations. These rights, including copyrights, patents, and trademarks, offer valuable opportunities for generating income and building wealth. Copyrights. Copyright protection is primarily applied to original works of authorship, such as books, music, films, software, and artistic creations. When you hold the copyright to a work, you have the exclusive right to reproduce, distribute, and display it. This exclusivity can be monetized through various means, including licensing agreements, royalties, and sales. For instance, musicians can earn royalties when their music is played on the radio, streamed online, or used in advertisements. Authors receive income when their books are sold or adapted into movies. These earnings can accumulate over time, providing a continuous stream of revenue. Patents. Patents protect inventions and innovative processes, granting inventors exclusive rights to make, use, and sell their creations for a specific period. In exchange for sharing their inventions with the public, patent holders can profit from their intellectual property. Patents are commonly utilized in industries like technology, pharmaceuticals, and manufacturing. Successful patent holders can license their technology to other companies or organizations, allowing them to use and develop the patented technology in exchange for fees. Alternatively, they may choose to sell their patents outright to companies looking to expand their intellectual property portfolios. Trademarks. Trademarks are symbols, words, phrases, or designs that distinguish and protect brands and products from competitors. A strong trademark can become a valuable asset over time, signifying trust and recognition in the marketplace. Brand owners can license their trademarks to other businesses for use in various products or services. This licensing can result in royalty payments or franchise fees. Furthermore, the value of a strong trademark can be appreciated as a brand's reputation and recognition grow, making it an attractive asset for potential buyers or investors. It's important to note that securing and maintaining these protective assets can be a complex and costly process, requiring legal expertise. Additionally, intellectual property rights vary by country, so you may need to secure protection in multiple jurisdictions. 12. Business ownership. Owning and operating a business is often considered one of the most direct and potentially rewarding ways to build wealth. It allows you to leverage your skills, ideas, and hard work into a profitable venture. Business ownership can take various forms, including starting your own company, buying an existing business, or investing in a partnership. Starting your own business provides a platform for entrepreneurship and innovation. It allows you to pursue your ideas, create new products or services, and respond to market needs. Entrepreneurship often involves taking calculated risks, and with risk comes the potential for substantial rewards. Successful entrepreneurs can build wealth by creating a business that addresses a particular market gap or by introducing an innovative solution that gains widespread adoption. One of the primary benefits of business ownership is the potential for higher income and profit. As a business owner, you have the ability to set your prices, manage costs, and scale your operations. The profits generated from your business can be reinvested for growth or used to increase your personal wealth. In many cases, successful businesses can provide substantial cash flow and, over time, accumulate substantial value. A successful business can become a valuable asset in its own right. The value of a business can appreciate over time due to factors such as growth in revenue and profits, expansion into new markets, or the development of proprietary technology and intellectual property. This increase in business value can be a significant source of wealth when you decide to sell the company. Business ownership comes with various tax benefits that can contribute to wealth building. These may include deductions for business expenses, depreciation of assets, and tax credits for certain activities, such as research and development. Effective tax planning can help reduce your tax liability, leaving more money available for investment and wealth accumulation. Investing in a business can provide diversification in your wealth-building strategy. While many people invest in traditional assets like stocks and bonds, owning a business can offer exposure to a different set of risks and rewards. Diversification can help manage risk and potentially lead to more stable long-term returns. Despite the numerous benefits of business ownership, it's essential to acknowledge the challenges and risks, including financial risk, the time and commitment needed to run the business, the uncertainty and unpredictability of the market, competition from other similar businesses, cash flow management of the business, legal and regulatory obligations, and the exit strategy for the business. Whether you plan to sell the business, pass it on to family, or simply close it, running a business can be demanding, requiring hard work, dedication, and a willingness to adapt to changing circumstances. Building wealth is a journey, and there's no guaranteed path to riches. It requires discipline, education, and a willingness to adapt to changing circumstances. Use these assets as building blocks and craft a strategy that suits your unique financial situation and aspirations. Over time, with diligence and patience, your wealth can grow and provide you with the financial security and freedom you desire.